In the last video, we talked about why the housing market is changing. The Federal Reserve is quietly stepping away from mortgage support. Inventory is rising into the worst affordability environment in modern history. Today, we're taking the next step. Because when housing changes structurally, it does not break everywhere at once. Some regions crack first, some freeze, and a few actually benefit. By the end of this video, you'll know which side of that shift your market is on. Most housing coverage talks about the US housing market. That's the first mistake. There is no single housing market. National averages hide stress. Median prices delay reality. And policy changes hit regions very unevenly. The Fed stepping away from mortgages affects everywhere. But what happens next depends entirely on local conditions. Housing is local. Liquidity is global. To understand which markets break and which don't, we need a filter. 4 variables decide almost everything from here. Variable number 1, inventory trajectory. Is inventory rising quickly or staying tight? And more importantly, is it new construction or resale? New supply behaves very differently under stress. Variable number 2, affordability gap. This is the silent killer. How far are payments from local incomes? Markets where buyers are already stretched have no margin for error. Variable number 3, investor concentration. Owner-occupants are sticky. Investors are not. Short-term rentals, speculative buyers, leverage. These amplify moves in both directions. Variable number 4, supply elasticity. Can builders respond quickly, or is supply constrained by zoning, land, and regulation? Markets that score poorly on all 4 are where stress shows up first. Let's start with the most obvious group. Pandemic boom towns. These markets share common traits: rapid price appreciation, heavy migration narratives, large volumes of new construction. When rates rose, demand faded quickly. Now, inventory is climbing, and price cuts are following. These markets don't need a crash to reset. They just need time. Builders become the marginal sellers here, and marginal sellers set prices. The second group is more fragile than people realize. Investor-heavy markets. These don't unwind from foreclosures. They unwind from exits. Cash flow shrinks, occupancy softens, costs rise, and once appreciation stalls, the math breaks. Small price declines trigger selling. Liquidity disappears faster here than almost anywhere else. Now let's talk about the markets that confuse people. Low inventory, strong employment, limited new supply. These don't crash, they freeze. Transactions collapse. Prices stagnate. But inflation keeps working in the background. Flat prices can still mean real losses. And finally, the group almost no one talks about: quiet beneficiaries. These markets have income growth, limited investor activity, buyers who still qualify. They don't boom, they hold. Resilience doesn't mean upside, it means survival. You don't need a forecast, you need a filter. Ask 5 questions. Is inventory rising year over year? Are days on market increasing? Is new construction growing? How investor heavy is the area? Can local incomes support current payments? Answer those honestly, and your zip code will tell you the truth. Let's bring this together. Housing is fragmenting. Macro forces are fixed. Local conditions decide outcomes. Some markets break. Some freeze. Some hold. In the next video, I'll show you how buyers and investors can position themselves inside this shift, when waiting beats acting, and when acting early matters. I'll see you there.